I'd like to talk a little bit how we do manage portfolios, and for a little fun, we'll do it in the context of a couple of predictions that are being made right now. So one making the rounds is the narrative that inflation continues, the Fed keeps hiking interest rates, that tips us into recession and stocks have to fall. The second is the question that comes up every year at this time, hey Mike, what is the stock market going to do this year? Now, with regards to the economy, there's the old joke that economists have predicted 10 of the last 5 recessions. They often predict them. They usually don't happen. This year is a little unique in that they're almost unanimous in their prediction of recession. And maybe we'll have a recession, maybe we won't. The famous economist John Maynard Keynes said, "The inevitable never happens, it's always the unexpected." And this is the very definition of risk. And we could point to any number of things that could happen that help us avoid a recession. Maybe we just have tepid growth, but not the technical definition of a recession by the government. Maybe Washington gets its act together. Maybe inflation turns around. There's some signs of that beginning to happen. Hopefully we'll have a resolution peacefully to the Russian-Ukraine conflict, and that might have a positive impact. But regardless of what happens in the economy, you should think about this as a stock investor. Historically, since World War II, during the 12 recessions we've experienced, stocks actually went up during 6 of them, so half the time. And in every single case, stocks were higher 1 year after the recession. History is no guarantee, of course, but that's from pretty strong historical evidence. Finally, for a little fun in politics, the year after a midterm election has been positive for U.S. stocks every time so far in history. We'll see if that holds. But the message is we want to own stocks and we want to own them for the long run. Stocks have historically been the best way to grow and preserve capital regardless of the ups and downs and the inevitable recessions that we'll experience from time to time. Now let's take that second question everyone's always interested in. What will the stock market do this year? Well, it's the time of year when the experts come out making their predictions we've been talking about. This one shows you all of the global or many of the global investment banks and their predictions for last year where the S&P would end up. Now, the S&P started at about 4,800. It ended around 3,800. That's a loss of nearly 20%. If you take the average of all these experts, they were expecting a gain of 4.5%. A couple predicted a slight loss, but nowhere near the magnitude we actually saw. Now you might think, well, that's a one-off year, we're cherry picking that, but unfortunately, if you look back over the last 20 years, you can see that while they get it right every now and then, they're close to the actual results of the market. You can see that in 2002, they were off by over 40%. In 2008, they were off by over 50%. We know they were off last year. We just looked at that. And so unfortunately, this is the case when we look at individual stock predictions as well. We've talked in past videos about some of the darlings of Wall Street recently. Tesla, expected to be a major player in the global auto market, is definitely making headway, but at one point it was valued as one of the 10 largest companies in the entire world. It certainly has not made that kind of headway if you look at its sales or particularly its earnings, and that stock is down over 70% from its recent high. Another one that experienced just tremendous gains for a time is Zoom. Many of us have used that technology with great benefit during the pandemic to conduct meetings remotely. That stock is still around. The company is doing well, but the stock is down over 80% because of its lofty valuation. Finally, I'll mention Bitcoin because we've talked about cryptocurrency today. Many experts thought and still do think that Bitcoin will one day overtake the US dollar or the yen or the euro as the global reserve currency. Maybe that will happen, maybe not, but as of right now, Bitcoin's price is down over 70%. So if you took any one of these 3 examples as an expert prediction of what was almost inevitable, the confidence that they predict them, you would have been in real trouble if you concentrated your investment there. So our outlook for stocks is the same as it is most years. It's that stocks will probably go up, but they might go down. And if that sounds trite or useless even, I'm sorry, but it's actually pretty good advice. Any given year, the chances are about 2 in 3 that stocks go up. you can see from this chart that historically this has been the case. No matter who's in the White House, no matter whether stocks went up or down last year, the odds are about 2 in 3 that stocks will go up. And we prefer to be pretty accurate with a non-specific prediction like that than to be really specific and be wildly inaccurate, which happens a lot of the times with the individual stocks. So as it relates to our clients' portfolios, instead of saying, well, we know X is going to happen, so therefore we'll do Y in the portfolio, we prefer to think about multiple scenarios that could happen and position our clients' portfolios such that no matter what happens, they're in a good place to grow and protect their wealth. And some of the ways we do that, including diversification. So diversification is a long, time-tested method that helps us avoid the catastrophic losses that can come if we're not otherwise doing that. We are rebalancing thoughtfully. When stocks go up, we trim them. When stocks are way down, we add to them. This helps us systematically buy low and sell high in your portfolios. In certain portfolios, we make periodic tactical moves, shifting assets around when things look way out of whack from their historical norms. We're constantly striving to upgrade our portfolios for clients. So sometimes an asset that's been performing just fine, we find a better alternative or one that we think has less risk going forward, and we'll upgrade the portfolio. And finally, we try to focus on the things that we can control. That includes the risk we're taking in an individual client, depending on their financial circumstances. It includes controlling our behavior and our emotions and helping our clients do the same when the markets are inevitably bouncing up and down. And it includes controlling taxes and costs and other expenses the best we can. All that may sound simple, but it's fairly hard to do. It takes discipline and patience, and fortunately we have decades of experience helping shepherd our clients' money so that you can focus on what matters to you most.